Hello, friends. Good evening. Welcome to this episode of Adjusting Entries Made Easy. In this episode, we'll be discussing about what exactly is an adjusting entry and how adjusting entries are made. What exactly is an adjusting entry? An adjusting entry is an entry that is recorded to recognize the revenues and expenses that the business has to receive or has incurred during that accounting period. So basically, remember accounting period. Accounting period is the period within which the business has to receive an amount on account of the goods that they sold or on account of the services that they made. For example, we might have sold accounts on credit. That means on account. That means we have parted with our services or we have parted with our goods, but we have not received that amount. But in reality, that amount is actually to be received during that month. So that is an accrual concept. So we'll have to recognize that. Similarly, we might have incurred some expenses like electricity bills or telephone bills or salaries and wages or rent expense, but we have not made the payment during that month or during that quarter or during that half year or the year end. So these expenses and incomes have to be accounted for to realize that what exactly is the profit or loss that the business has made during that accounting period. So this is basically an accrual concept to recognize and book the actual incomes and expenses during that month. So accounting period, please remember, it may be a month, it may be a quarter, it may be half year, or it may be a year. And what exactly are we recording? We are recording any unrecognized income or expenses. So that means we have not booked that income or expense, but we are trying to book that to record and to realize the actual profit or loss that the business has made during that month. So it is called an adjusting entry. Adjusting entry is to see how much the business has to pay or receive during that accounting period. For example, we'll take one small example like insurance expense or supplies expense or rent expense. How do we identify this? So first step is to identify whether we have actually incurred any expenses or whether we have used up any supplies or whether we are supposed to pay any salaries and wages. Once we identify that, that is the potential event. Then how much is to be adjusted? That means how much of supplies have been used or how many months of rent has been used up or insurance has been used up. That is to determine the amount of required adjustment. The third one is which account is to be debited, which account has to be credited. So basically, adjusting entry, first recognize that event. The second point is what is the required adjustment? That means how much amount. Third one is which account to be debited and which account to be credited. Once we are done with, then this adjusting entries will be taken to the trial balance, which is called adjusted trial balance. That means an adjusting entry is recorded between an unadjusted trial balance and an adjusted trial balance. So it is in between. So some of the events which have not gone into the unadjusted trial balance will go to the adjusted trial balance, from where we will take it to the income statement. So we'll discuss about adjusting trial balance and income statement in our next video. So what are we? So we have got four steps: identify the event, determine what is the amount to be recognized, and third one is which account to be debited and which account to be credited. The fourth one is recording actually the journal entry, that is called adjusting entry, right? So we have discussed how examples can be supplies expense, can be insurance expense or rent expense or depreciation, whatever. So we'll take a few examples and see how to record these adjusting entries. Let me give you one small insight as to what is the adjusting entry by taking a small example. Like suppose in a family of two, we have two loaves of bread at the beginning of the week. Then we go to either Target, Walmart, or Whole Foods, or Natural Grocers, and or Sprouts. You go there and you want to buy, let us say, 5 loaves of bread. You feel that it is required for your use during the week because you are getting some guests. You have invited some guests. So that means you feel that okay, 7 loaves of bread is sufficient for this entire week. But actually what happened, the guests that you were supposed to get were either busy or only a few of them turned up. So you used up how many breads, loaves at the end of the week? You do not know. How to arrive this? Beginning, you had two loaves. During the month, you purchased five. And the end of the month, you are left with three. So that means I have to see the expense of the supplies. Here, the supplies of bread. How to calculate this? So there is a formula. What is that formula? Beginning inventory plus purchases minus ending inventory. Beginning inventory plus purchases during the month or during the week, and whatever is left over will give you the number of items that is spent. So in this case, what is happening? Two loaves in the beginning you purchased five and you are left with three. So 2 plus 5, that means beginning inventory plus purchases you have added and you have subtracted what is left over to determine the supplies expense. So this is 4 loaves of bread have been used up during that month. It is as simple as this. Okay, so now let us take one example of a real life case wherein Robin and company has paid $5,760 towards rental advance. 6 months rental advance they have paid by debiting, let us say, it is actually rent advance, not insurance advance. Assume that it is a rental advance or insurance. Okay, insurance. The second one is purchase supplies costing $7,750. Supplies on hand at the end of the month was 2750. The third one is purchased equipment for 67,200 and it has a useful life of 10 years with no salvage value. You have to book the journal entry, that is adjusting entry for the month of June. So only for 1 month you have to book the adjusting entry. So let us take this example, that is 1st of June, $5,750 have been paid as rental advance. Um, so what did we do? We had debited prepaid rent. When we paid 5,760, you debited prepaid rent. So now you are used up how much? 1 month, because 6 months you are paid. For June, it is 1 month. So divide the amount by 6 to get the amount of rental expense. So since expense, rent is an expense, we have spent it, we debit rental expense and crediting prepaid rent. We don't credit cash because we are not paying cash now. Cash has already been paid. 6 months, for 6 months of rental, we have paid cash. So debit rent expense, credit prepaid rent for 960. How did we get this 960? We divided the 5,760 advance by 6 months and multiplied by 1 month, that is for June we have incurred. So that is an adjusting entry. Then the second adjusting entry we have to see is company purchased supplies worth of $7,750. So the supplies on hand at the end of the month was 2,750. So that means how much of the supplies have been used up, how much of the supplies has been used up. So remember the example of the bread we discussed, bread loaves, beginning inventory plus purchases minus ending inventory. Here they have not given the beginning inventory. So we have to assume it as 0. So 0 plus 7750 minus 2750. That is what we have arrived here. That means 5,000 worth of supplies has been used up. So what is the entry? The entry would be supplies expense 5,000 debit, because we have used up that much of supplies. And why are we crediting supplies? Because supplies is an asset which has been used. So to decrease the ending balance of supplies, we have to credit, because supplies will reduce. To reduce the asset value, we credit it. Why are we debiting supplies expense? Because we have used it or spent it. So supplies expense debited, supplies or credited. Supplies being asset, to decrease the asset value, we credited. So this is the second entry. Then the third entry would be equipment has been purchased and the value of the equipment is 67,200. What is the life of the asset? 10 years. There is no salvage value. That is, there is no salvage value. That means how much is the depreciation expense for 1 month? So to calculate depreciation expense for 1 month, what we have to do? First, we have to divide the cost of the equipment minus salvage value divided by the life, that is 67,200 minus 0 being salvage value divided by the life how many years? 10 years. So that will give us 6,720. So that is for 1 year. And for 1 month, what are we going to do? We have to divide that by again 12 months. So 67,200 by 10 is 6,720. 6,720 divided by 12 will give us $560. So $560 would be the amount of depreciation expense on the equipment. So what do? We debit depreciation expense and credit accumulated depreciation on equipment. So these are the simple adjusting entries which we have seen and we have discussed. Hope you understood this, friends. And I will be coming up with you in another video with more adjusting entries, where we'll be discussing various aspects of the adjusting entries and how exactly we take them to an adjusted trial balance. We'll come up with the beginning trial balance unadjusted, then adjusting entries, then the adjusted trial balance, so that we know how the financial statements are prepared from the adjusting entries. Friends, hope you enjoyed this video, and I'm sure you would like to love and subscribe to my channel. And I look forward to meet with you and talk to you soon. And if you have any comments, please do give the comments in the comments box, and I would be responding to your comments. Thank you very much, friends, and enjoy the rest of your day. Have a good evening. Bye bye. See you soon. Take care. Thank you.